Have you seen down rounds? Is it something that happens? Do you think founders should actually postpone the raise? Is it easy to come to a conclusion and have the discussion about the valuation with the entrepreneurs? What would you say and give a tip for the entrepreneurs to do now when raising a new funding round in the current market?
Good morning, everyone. On behalf of Marja 01, I would like to welcome you all to this month's community breakfast. On the community breakfast, we bring our community members together to enjoy some breakfast, some new faces, networking, and then some quality learnings delivered by our networks. Today's topic is there life after a down round? And to answer this question and shed some light on the current fundraising market, we have brought Evli Growth Partners, an investor network member of our community, to help. Today we will hear a keynote and a panel discussion with a lot of experience and knowledge from the field in those. But to get the morning, and actually I'll just state that in the end we will have some time for your questions as well, so keep those ready. But to get the morning going, we will hear a keynote from Riku Asikainen, the founder and managing partner at Evli Growth Partners. Riku has a background as a serial entrepreneur and an angel investor, and has 30 years experience with 50 companies. So Riku is the man to go to help your beautiful companies grow. So Riku Asikainen, welcome.
Hello, my name is Riku. Great to be here. So it's some 20 minutes. I'll try to go through a little bit of the current market, especially on the pricing side, and then a short introduction into down rounds and how do they affect founders and a little bit also other investors. So that's what we are going to do. It's a little bit technical. I'll try to share some light on a more kind of a lighter way, but it's a little bit technical, and then maybe if you have never done an round as a founder, this can be a little bit overwhelming. But you know, after the presentation, the fun starts with our beautiful panel. All right, so let's go into it. Maybe just briefly about us. What is Evli Growth Partners? So it's not evil growth partners like most foreigners tend to read it. So we are 5 years now investing from our second fund. Would like to have a 300 million funding program in place by end of next year. Would like to invest 5 to 10 million into A and B rounds in Northern Europe. We have so far done 11 investments in 9 different countries. So two Finnish companies, but we don't have any of the CEOs in Finland. So the Finnish companies have CEOs in London and New York. So fairly international. Typically, the investments from our side, the entry ticket 5 million plus, and then doubling it up. So I would call it in Finnish terms maybe a B round investor. And unfortunately, there are not many players like us. We are all in all 11 people, 5 partners, senior partners, and then a great team of 6, a little bit younger, actually working partners. We have partners and working partners. Good. Then on the companies that we are looking for companies with about 5 million revenue onwards, fast growth. To us, it means revenue growth. Doesn't mean that your plans are growing. It's typically fairly difficult to find that type of companies. In the fund number 1, which we have now closed, we don't do any new investments from that. The average last 12 months revenue when we started was when we made the investment in those companies was 16 million euros. So a little bit more than the 5 million. Currently, the companies are in 70 million range. So they have, during our 3.5 years of ownership, they have grown on average from 16 to 70 million. So the average growth is about 60%. So not quite the 100% what we are looking for, but the market have been fairly tough as well. Good. All right. So let's then go into the topic. What is a down round? So the definition is here. Other way to say this is that basically you are making a new equity round where the per share price of your company is lower than in the earlier round. So instead of selling the shares 10 euros a piece, you're now selling them for 8 or 6 euros a piece. That's a down round. The traditional saying in growth kind of circles is that that's a really bad thing to happen. That basically kills your story. It's difficult to get further funding. All kind of negative things about it. The founders will lose major part of their shares. There are all kind of things like that. That people tend to relate to down rounds. Okay, we are going to talk about those today and see that it might not be true all in all. And also I would like to remind everybody that we are in a risky business. We are trying to find really fast growing companies and there is no security on you first of all making it and second of all making it in a way that it's a good investment. That there are a lot of companies that require so much funding that they are actually not profitable for many of the investors nor even to the founders. Look at WeWork. They receive billions. I don't even remember 20 billion. They were once valued in tens of billions and now it's bankrupt yesterday. So you never know. So down rounds can be there. The idea of any equity raise is of course that you are selling shares in order to finance your company growth in the future. So if you don't have that growth, then don't sell the shares. If you have the growth, then it might make sense to do that. So that's the basic discussion here. Good. We have Sami here that is going to talk a little bit later today, and then he's from this fantastic company Translink, and this is their recently released numbers. I know that this is fairly small, but this is a price to sales multiplier for SaaS companies, and I don't know how well you can see, but on the higher here, that's the US companies, and then this a little bit darker here is the European SaaS companies price to sales valuation multiples. And it starts from 2018, and there is a current situation on that side. Couple points here. One is that the average multiplier for US companies is about 10 times price to sales, and that's what everybody in Finland also talks about, even though that the European average is 5. So for an investor, it's difficult to if you have an access to US market, it's difficult to say why would I invest into European SaaS companies when at the best they are giving you a little bit less than 10 times price to sales multipliers when the US companies at best are at 25. So you have much higher upside on the US companies. That's already kind of negative thing for European companies. Okay, that's somehow reflected here. That currently the European companies are about 3 times price to sales when the US companies are about 5 times price to sales. And the discussion and why are we here today is obviously because the quite significant drop on this, and we are going to talk about this. That what does it mean in real life? And finally. One more point here. I think that this was very well done from Translink to put this here. So here you have the average sales growth and average EBITDA margins. So basically the rule of 40, if you are familiar with that. The rule of 40 in Europe is actually higher than in US on average. They are almost the same, but it's actually a little bit higher in Europe. And still, the European companies are about 40% less valued. So that's good to understand. Okay, then one more slide on pricing, and then I leave Translink material out of my presentation. So if you look at the market in three different performance classes, so outperformers, market performers, and underperformers by rule of 40 ruling. So market performance being between 20 to 40, and then the overperformance being above 40 on rule of 40. You can see that the outperformers, by this is not a big surprise, I hope, they are actually getting a higher multipliers than the market underperformers. But it's not very kind of the strange thing here is that it doesn't seem to be that well correlated, the numbers, that you can have really well performing companies that are actually not getting really very well paid, and vice versa. If you add, and I didn't do that, but Translink guys had already done that if you have the traction of your customer base added into this, then you have a little bit more you can find more correlation between the pricing and the actual performance of the company. But here the point is that the changes here, if we look at this on the horizon of time, then these were much higher on the boom times than what they are now. Okay, so what does that mean in real life? And this is now an example for you. So and now all of the cases that I'm kind of using as an example here are really good companies, like a good company performance cases. So these are not like a poorly performing company. So we are looking at the company at 2021 with 7 million revenue. Okay, that's already, there are not many companies like that in Finland. We would have maybe 5 or something like that, 5 to 10 SaaS companies that have 7 million revenue. And if you then had a 12 times price to sales multiplier, then obviously you would have a valuation of 84 million. And that's what many of the founders in Finland heard when they were discussing with bankers or anybody in the market. In 2021, your company is valued something between 70 to 90 million. Then let's move 2 years onwards. You have done fantastically with your company. In 2 years, you have grown the company revenue from 7 million to 14 million. Not bad, not quite as good as what our average companies do, but it's already okay, from 7 to 14. But because of the revenue multiplier has now dropped from 12 to 4, which is higher than the average in Europe now, your actual valuation is 56 million, which is obviously lower than 84 million. So even with the doubling your revenue in 2 years, you end up having a valuation lower than what it was 2 years ago. And that's why we are today talking about down rounds. That it's very difficult to have an up round in the market conditions like this in a long period of time, because if the multipliers stay on level of, let's say, 3 to 5, and they used to be on 12 to even higher, 16. Good. Little bit about the dilution and how does it look like in a kind of textbook way. So in a typical setup, founders, of course, in the formation of the company have 100%, and then the more rounds you have, the less founders have as a percentage of the company. And like we saw, this looks like a really small portion, 5%. Maybe it's below the Finnish average, but typically in Finland we don't have as many rounds before the exit. But if you go really on a big IPO exit, like let's say a US Nasdaq type of an exit, then 5% would be fairly typical. And actually what is interesting here is that the employees stack is quite close to 20% from very early on. And at the end, investors will have a vast majority of the shares. and they have to pay for it. They don't get it for free, and let's look at a couple of the examples now. So I'm trying to present something that how does it concretely happen in a couple minutes. Here we have a fantastic company that has a revenue of 1 million at the seed stage. At Series A, it grows 100% every year, so it goes from 1 to 32 million in revenue. It has a 8 times price to sales multiplier because it's such a great company. It grows all the time, 100%. And it has investment rounds in these different rounds. They are from 2 to 50 million. And the valuation, of course, then goes from 10 million to 306 million at the end. And now the question is that what happens to the ownership of the founders during this process? And it actually goes fairly neatly. So even though that your ownership kind of dilutes to 17% from 100%, your ownership value goes from 7 million to 52 million during this process. So everything is good. Okay. And those are the kind of most important parts that we are going to look at today, between A and B rounds, and then what happens at the end. Because what we have now, what has happened in company B is that it actually used the possibility of these great market conditions 2 years ago, and instead of having a round priced at 8 times price to sales, it has priced around 16 times. So something that was really, they used the opportunity 2 years ago and got a much better valuation at that time. So the owners had, instead of 10 million, they had 21 million. And now, if the reality bites, and they are actually not receiving 8 times price to sales multiples, but 4 times, so what is happening exactly now, you are actually going to see a down round right here. And this is a down round. You are having a valuation of the company from 38 million to 26 million. And of course, this is then going to hurt the ownership of the founder. But if the markets return to normal, and the end of the story is the same as in the above example, there is actually not a big difference or almost no difference on the founder's outcome. So my point is that if you do a one down round, but the company continues to grow and you are able to bring it to be a very expensive company at the end, it doesn't really matter, for as long as you always raise the money on market terms. That if you have a company like this company, which is growing 100% every year, it should get at least the market average pricing on its when it's raising money. And if you are able to do that, regardless of the kind of bad outcome here, having a multiplier which is 1/4 of the earlier round, and the price being about 70% of the last round, you still end up having almost the same amount. And that's the point that I'm trying to make. We have another example here, but maybe this is with the stagnating growth, and my point here is that everything else was same as earlier, but now this company is not growing as fast as we were talking earlier. So this is now hitting a slower growth situation. Then, the ownership of the founders will be reduced, and you are fairly hardly hit by all of these down rounds. Is this a surprise? I think it should not be. If you are not able to grow your company, somebody needs to pay. You are one of the people that are going to be paying. Also, all of the investors are paying, but your ownership it cannot be protected if the company is not producing its numbers. That's maybe the end game here. Couple points from our side, how to protect the founders. To be completely honest, sometimes we don't like to protect all of the founders. Sometimes we like to pick some of them. We like to say that, okay, I like to keep you and you and you, but maybe it's time for you to for somebody to move away. How to do that? Maybe there's a secondary option. Maybe you can buy the shares. there's some discount on the shares, and you know, a person can move on. Quite often it's a mutual feeling that some people feel that, okay, now the company is in, you know, I like to work with companies that have 5 to 30 people, not companies that have 350 people, and you know, there are people that are that way. I'm that way, for instance. So if somebody offers me money and then I can start a new business, it's quite okay. But good. Typically, the solutions are something to do with options. So it's not very typical to give options to founders in a normal funding round, where there's an up round, because the founders, of course, have a stake in the company. But if the stake of the company is below something that we would feel being a motivational, then we could have more options to the founders. Then I was already talking about the secondary offering. That can be also thought in the other way, that if you have a stake of 10 million in a company, and that's all of your money, which is the case in almost all of the cases, that it's more than 100% of your net wealth, then maybe if we buy, you know, a little bit of that and then give you cash to buy a flat, then that sometimes releases the pressure even on the down rounds. Then the liquidation preferences, that's a discussion for both sides. So to understand that how the liquidation preference setup is done, that's important for founders. Then it's about vesting and salary questions. Vesting being that you know, when are your shares free to be transferred, and that's a discussion in a down round. Maybe we can have a target that if you can hit this revenue target, then the vesting is accelerated or something like that. And then, of course, salaries in a later stage rounds. So typically our rounds are about 25 to 30 million. So the salaries are already, you know, there is a budget for salary. So instead of you getting 3,300 a month, then maybe you can get a decent salary. That's also important for founders. Good. And what happens to the existing shareholders in a down rounds? First of all, you know, don't feel sorry about, you know, they're supposed to be professionals. It's their money. So you know, we can't protect everybody in this. This is a case that if things go sour, then somebody needs to pay. It's typically the shareholders that pay this. And there is, in my mind, no way around it, and it's not because, you know, there's always a bigger fish than me. So don't think that way, that I'm the big fish here. I'm not. You know, obviously there are a lot of big investors in the world, and they're going to think this way. So it's up to us to invest in companies that are self-sustaining, or at least that they can reach that stage at will. And that's especially dangerous for investors that can only invest or want to only invest once. So if you only enter into the market once, then of course you are very sensitive to the pricing changes. If you are able to invest in very early stage, like my friend Kim Väisänen invests as an angel, has a 10% stake on the company, he can protect his 10% until, you know, forever. And then the valuation changes don't really matter if at the end you end up having a 300 million exit. You still have 30 million out of it with 10%. Good. That was maybe my points here. We can then ask for the panel to continue.
So next up, we will hear from the panel of experts, and the panel will be hosted by Pauliina Sinnemaa, the investment manager at Evli Growth Partners, and Pauliina will be joined by Kim Väisänen. Kim is a general partner at Evli Growth Partners. Kim is a top-notch angel investor and the chairman of the Finnish Business Angels Network. With Kim, we will have Kimmo Reina, a partner at Bird & Bird. Kimmo has managed the legal side of many big funding rounds. So vast amount of knowledge on structuring the legal side of them. Then we have Sami Miettinen, a partner at Translink, a top-tier M&A advisory from Finland. Sami has advised various startup and growth companies in the funding and sales process. With all these experts, I believe that we are in for a treat. And just to remember, keep your questions ready for the end. Without further ado, I will hand it over to Pauliina. Welcome.
Thank you for coming, all of you. So just a recap, we have a top-tier investor, top-tier M&A advisor and top-tier lawyer here together with me. So I think Riku gave us a lot of things to think about already, but maybe it's interesting to hear your thoughts also. Kim, maybe we can start with you. What would you say, what's the current market like, and do you see down rounds already happening, or is it something that you see in the future more likely?
Yeah, I think that sentiment is more or less like being a captain of Titanic. If you're a founder, to be honest, half of the money has more or less disappeared. I actually follow fairly carefully macro numbers from the pitch book, from the Grand Space, from the Translink, from the Nordhaven, and then I have a fairly good understanding what are the valuations at the moment. But let's face it, there was insanity in startup investments, investing. In October 21, which was the peak time according to the Grand Space, typical SaaS company exit value was 14 times sales. Now it's roughly between 3 and 4. Sami probably knows it better, and it's still coming down. And I have done now 50 companies myself. Rounds altogether roughly 110. I haven't actually calculated because I have been so busy saving those investments this year. This year I have probably burned more money than ever trying to keep the company afloat, that they don't go belly up. And then down runs are actually happening. That's a reality. In the beginning of the year, I got involved with a company which had raised money with 23 million pre-money valuation. In the beginning of the year, I invested the company with the 10 million valuation, 500K, which is quite a bit of money from me. And now I actually had to invest another roughly 300K with 4.5 million valuation. So within this year, we have gone 23 million, 10 million, 4.5 million. And I was actually trying to sell the round to the other people, those ones who actually participate 23 million round. And I said, hey, this is bargain. And they were like, take a hike. We don't want to be in with the company. And the company most likely is going to go belly up in one way or another, which shows how stupid I am as believing to the people. But the thing is that the outcome in this particular case shows that the valuation is roughly 1/5 what it used to be. And that's reality. But in the past, the founders, you are such a young crowd, I think many of you were our founders, you actually had an enjoyable ride because you could save the cake and you could eat the cake. And what I mean with that, you got extremely high valuation for the company in a round. Secondly, the founders, which I see a lot of data, that they actually compensated fairly well. I think that you are doing the paperwork, you have seen that they are paid too much. They have been able to keep their shares or their ownership, and at the same time you were able to sell secondary shares after 2 years of hard work. 2 years. And then I said, what is the rationality for this? And most cases I got this answer, well, the rationality is that I can reduce my risk. And you had worked like 2 or 3 years. And I envy you because in the past I had to work a decade before I could get dividends or sell any shares. And things are still rolling to the worst direction, probably a quarter or 2. So don't expect that you are going to get great multiples on the sales or anything else.
So like you can see, this is a marketing event.
Yeah. Okay. And the down round is also following that now there are companies which are doing top-up rounds to the previous rounds, and the sales have tripled or quadrupled. and still you get exactly the same valuation than previous round, but it's not called down round, you just call it top-up round, that we just extended it. You're fooling yourself. Thank you.
Thank you.
And if you have any monetary needs, I'm a startup angel, 50 companies, 110 rounds, talk to me.
Okay, so now we've heard about the valuation multiple decreases in SaaS companies, both from Riku and then now from Kim. So Sami, what would you say when it comes to now actually talking about the new rounds and prices of the rounds, and if they are priced with the kind of these new multiples, do you think they're all down rounds, or how would you call them?
Riku said that there are 5 companies with over 7 million of ARR. So at Translink we are apparently selling one of them. So this company is not the down round, but it did its last funding last year. So it's not fair game. Riku's point about our data that 2021 was the peak multiple is correct. So some rounds have been done not in 21 or 20. But in last year, and then obviously they are not down rounds. And this company, we are doing a 15 million B round, has a very high EBITDA and a very high growth, and it's over the magic threshold of over 1 million MRR per month. So obviously this company is gonna get good valuation, at least I hope so. But a couple of trends. By the way, this Translink report is free to download, and it has you don't need even to put your email there, so you can just rip off the PDF without disclosing your identity. Couple of points about what makes valuation high is there's a switch from the kind of mindless growth to mindless growth and profitability. So EBITDA matters, or gross margin. And if you look at the valuation multiples, they are highest for the companies who have high margins. And they still have a growth, but you get more reward for profitability. And it doesn't mean that you now suddenly need to switch to a bootstrapping mode, but there's a kind of a tendency that you can't just keep growing with investors' money, and you have to find your profitability.
Right, and now you see a lot of companies and see kind of their growth as well. Have you seen a lot of companies that have tripled their revenues during the past couple of years with the new current market?
Yeah, it can be done, because if obviously if you have a 100% year-on-year growth, then you outpace the multiple. But then the multiple composition, I mean, it's absolute numbers game, but then you multiply them with the revenue multiple or ARR multiple, and if you have a high profitability, then you get a higher multiple. But then another factor which has come is the net revenue retention, so or negative of churn. So if you can kind of get more from your customer base, and your growth is quality growth, then that also increases the multiple. So, but obviously that's a bit hard to find that kind of sweet spots.
Yeah, exactly.
But NRR, that's the and the EBITDA, those are now as important as growth.
Thank you. Okay, let's then switch to lawyer's perspective. Kimmo, have you seen down rounds? Is it something that happens kind of from your perspective, and also has it affected somehow your deal negotiations in any way?
Yes, so I would say that I have seen surprisingly little down rounds thus far in our client cases, but that's mainly because the companies who have needed funding during the last 1.5 years or so, they have raised the new funding in the form of convertible loan. So they have not had to price the round, and then the idea is that convertible loan will then convert to equity in the next funding round, and hope is that that would not be down round anymore. So there have been a couple of down round cases that we have been involved, but mostly it's been ways to just to delay perhaps the inevitable by first raising new funding in the form of convertible loan. And well, in those down round cases that we have had, obviously, if the company has to raise down round, it probably means that its bargaining power towards the investors is not very high. So we have seen also more investor-friendly terms in those cases than used to be the case in the last several years, where the terms were more founder-friendly. For example, in terms of more investor-friendly liquidation preference provisions or more veto rights for the investors to control the company.
Right. You mentioned convertible loan notes or agreements there, and so could you maybe first explain to our audience shortly the mechanism behind that?
Sure. So it means that instead of issuing equity, you take loan, and then the loan has a term or provision that in the case of next equity funding, it will convert to equity. And normally how it works is that, normally that loan has, in my experience, maturity of 1 to 2 years. And then if you manage to raise an equity round of certain minimum size during that time period, then the convertible loan will convert to equity at some discount compared to that equity round valuation, typically 20% discount. And then in addition to that, the loan may or may not have some annual interest as well. So the idea is that when the next qualified equity funding round, which means that the minimum size threshold happens, then the convertible loan will convert to equity. If there is no qualified funding round during that maturity period, then typically the investors can decide whether they wish to convert at some pre-agreed valuation or whether they rather stay as lenders, although I guess in most cases the company would not really be in a position to repay the loan in that kind of event.
Yeah. So tell me if I'm crazy, but let's say in these current market situations that it's already a down run that's going to happen, and then you have this convertible loan agreement, and there's going to be this 20% discount approximately along with interest. It doesn't seem like a really good deal for the entrepreneurs to start with.
And it's not really good term for the investors. I'll provide you an example. Framery, which is fairly successful company, making phone booths, I actually gave them a convertible. I don't know, it was 150K or something. And I was so generous, because I'm a generous person. I might be pessimistic, but I'm generous. I said, you can decide one day if you pay me the loan back or if we convert to shares. So then I got, I think I got 7% on 150,000 euros as an interest. But in an exit, I could have got 5 million euros. So be careful what you wish for. That there are people who are generous and also stupid.
Yeah, that sounds very generous. Normally the investors are always at least allowed to convert, and in the case of qualified funding round also obligated to convert. And typically they also have a provision that if there would be exit before the conversion, then the investors would get, for example, the loan back 2 times or something like that.
Great, thank you. Okay, Kim, so when it comes to fundraising at the moment, do you think founders should actually postpone the raise or just continue with it? What's the...
I think founders should do whatever is possible for survival, because there's many companies which are actually running out of the money. That's a reality. And then 2 weeks ago, no, actually last week ago, founder gave me a call at Friday and she said, well, Monday is the payday. And I was like, okay, that's great. You actually pay salaries. And well, she said, there's a 31,000 missing. And I said, hey, what are we going to do about it? And then he said, well, can you give me a bullet loan for 2 weeks? And the 2 weeks will actually expire this Friday. So I'm actually curious to see if it happens, that I will actually be paid back. But the thing is that there is only one crisis which company have, and it's more or less cash crisis. That you don't have a working capital, i.e. that your till is empty. And you have to do something for it. Yeah, the thing is that you can't unpay the employees. They have their kids, they have their rents, they have their utilities to pay and so forth. And then I sincerely wish that you don't start the fundraising like 2 months before you will run out of the money, because then you will run out of the money.
Yeah, I would add, I'm an investment banker, so we are even more cruel than that. So we usually don't take a case if you kind of haven't had your bridges built for cash flow for the next 12 months. And meaning, of course, we are the primary solution. We get the external investors, but we have this talk that we can't have a process which will lead to liquidation in the middle of it. So there needs to be a plan B. So the current investors need to pony up, or the bridges from convertible bond need somewhere. They can't be bridges to nowhere. They need to convert. And if you have bridges which convert to next equity round, but you don't have a fixed price, then you should renegotiate to a fixed price backup there. And also in the Finnish system, the companies generally can't have a negative equity you need to file that to the patents office.
You should file it.
Yes. So that's another constraint. You can't keep rolling the interest to run your equity to negative. So we kind of bring the sober truth to the picture. And even then, sometimes we just say, well, this is not for us because we don't know the industry or we don't know the potential new investors. So, but it's tough out there, but they always have a plan B. There's a Finnish saying in my negotiation handbook, jos sinulla ei ole vaihtoehtoja, sinulla on vain ehtoja. If you don't have options, you only have forced conditions.
Okay, so continuing regarding the same topic, the conversation that you have with the entrepreneur. So kind of your first point of contact with the company's valuation is when you decide to take them kind of as your client and then take their funding round. And so is it easy to come to a conclusion and have the discussion about the valuation with the entrepreneurs?
No, there's hopes and dreams, and which tend to be smashed these days, and then there needs to be realism and understanding of the situation. Sometimes the company is great, in which case there's no problem. It's just like in the last good years, but our model usually works quite well because we don't have a monthly retainer, so we have milestones for material and LOI, and then the big payment for success, and we sometimes even accept shares as a part of the payment.
I have, by the way, a couple of companies which I could introduce you.
Thanks.
The thing is that you have to face the reality, and that's a challenge. That there's a company where I'm a fairly large. Riku, use an example. Kim is 10% shareholder. Actually, I'm a 10% shareholder with quite a few companies because I have been able to defend my pro rata. I have enough money for that. But I was in a company, I was a board member, then was a chairman of the board, then I was a board member again, and then they kicked me out, which is a kind of typical story. And then I actually spoke with it's funded by the Swedish, or actually Scandinavian VCs at the moment. And I spoke with them last week that how is it going with the company, and they said that they had a frank discussion with the founder. The company is running out of the money in May, which is fairly soon. You wouldn't take them as a customer, I guess. And then I asked that how did the conversation go, and the female board member said that she spoke with the female founder and said that we are not going to fund this company any longer. At least not with the terms, because their growth has kind of faded away, just to 20% a year, but they make minus 50% on EBITDA on versus revenue. And I said, how was the outcome of the discussions? The board members just stated that founder was furious that the current investors are betraying them, because it's a betrayal that you don't have the pot of gold in the end of the rainbow, i.e. in May, that they can carry on doing what they want. And now they had been able to cut the loss half, and they still said that we are not going to fund you, that you have to be in at least break even. So you have to be really, really on top of what are the market conditions. And remember one thing, that when Salesforce, which is ultimate SaaS company, their slogan used to be no software. It was like one of the first SaaS companies. When it had this IPO, its valuation was 2 times ARR. And we went from that 2 times ARR to the 14 times, and now we are something roughly 4-ish.
Yeah, or in the USA is more 5-ish.
Yeah, Europe 4-ish, and Nordics is something like 3-ish. And you can't, if you were financed in the previous round, let's say 8x ARR or 7x ARR or even 10 times ARR, you're not going to get that unless you have a 30% EBITDA and you're growing 30% a year and all of those nice things. Be realistic.
And what do you see how the future is going to look like regarding the valuations?
Based on my this year investments, it looks rather gloomy. But there's one cool thing which gives confidence. In 21, the starting funds actually collected more commitments from LPs, limited partners, for those ones who invest to the funds more than ever. However, funds like we in Evli Growth Partners, that we haven't called the money from our LPs because they haven't been just the right cases for us. Or there has been a right case, but we haven't been able to find a follower, or we haven't been able to find a lead for the round, and so forth. It's gonna get better for sure, because the funds have a lot of commitments from the usual suspects like pension funds and other such. The money has not just been called in, because we investors, we are like a herd. We go always same direction. If we go to the overvaluation, then we go undervaluation, and hopefully one day we will be back in a normal, i.e. that it's something like 5-ish, 6-ish ARR, which is acceptable.
Yeah, on the valuation multiples have stabilized, so they're not going down anymore. And I think there's a little bit of a silver lining, because it wasn't only COVID which was boosting the multiples and a kind of a bubble, but it was the negative interest rates. And now we have had this massive hike of interest rate cycle, and it looks like it's peaking. So that will have an effect on the multiples. So there's could be normalization coming from that, but obviously the bubble is still a bubble, and we're not gonna go there.
Yeah, the slide has come more stable.
Yeah.
And we did have we had an internet bubble in a millennium, and yes, we did have a SaaS bubble.
And a COVID bubble as well. I mean, there was like e-commerce was having a specific bubble of its own, because people were stuck in their homes.
Okay. So basically there is still a lot of money in the market.
There's a
to
lot
be
of money,
deployed.
but there's a lot of unwillingness as well.
Yeah. Okay, Kimmo, switching to protecting ownership and valuations for, let's start with entrepreneurs. Have you used a lot of, or have contractual mechanisms been commonly used in the previous funding rounds, or not, from the legal perspective?
Well, I would say that normally there are really no mechanisms in the agreements to protect founders from dilution or from down round. So basically all the contractual mechanisms that you would typically have are meant to protect investors from down rounds or from dilution in the down rounds. But obviously the founders can and should negotiate those terms that they are also as friendly from the founder's point of view as possible. then from the investor's point of view, so the most typical way the most typical contractual provision how the investors protect them from down rounds is so-called anti-dilution protection, which typically you don't have it in seed round, but from A round onwards, in most cases, the investors would have it. And how it works is that in the case of down round, the investors are then given certain amount of shares free of charge to protect them from that extra dilution that they will suffer as a result of that down round compared to flat round or up round. And there are different types of anti-dilution provisions. So normally they don't protect the investors fully from that extra dilution, but they reduce that extra dilution that they would suffer.
And have you seen differences between kind of, you work with international people a lot, investors also. Do you see differences in these kind of contractual matters in different countries?
Well, I would say that not really in my experience. I would say that the concepts and provisions that you have in shareholders agreements or investment agreements of VC-backed companies, they tend to be very international. So at least in my experience, there are really no big differences between Finnish or European or US investors in terms of the contract terms that they would require.
Okay. Do you, Kim or Sami, have something to add to this topic?
Yeah, I guess you have the ratchets and then you have the liquidation preferences. I guess in my experience, which might not be very conclusive, the international investors kind of push a bit nastier liquidation preferences, but maybe that's just me. By the way, Riku had a good idea, which we have also used to kind of smoothen the blow of those anti-dilutions to the founders, which is you can have a kind of performance-based warrants. So if you do your KPIs, you get a bit of a dilution back. So that's one way to combat it in a creative way.
Yeah, when the weather is good, you're gonna get good terms. When weather is bad, you're gonna get bad terms. It's as simple. That it depends. If the market is going up, it's more founder friendly. When market is going down, it's more investor friendly. And I don't know if there's a balance actually on those.
Okay. I think we are slowly running out of time, but still have a few questions. Maybe Kim, you could start. So, what I've seen when talking with entrepreneurs as an investor, even though the previous investors would be able to take the whole round that they are raising, they actually want to have a new lead because they want someone else to price the round. So, Kim, why is this happening?
I think in a way it's a sanity check that somebody else does the valuation for the company. Secondly, I would really hesitate to invest in the company where none of existing investors is participating. It tells a story that they don't believe to the company. And then recently I had a good discussion that there was a CLA going around, and then I took a look who are the current owners of that startup, fairly well-known company, and there were some of the most wealthiest people in Finland. And the round wasn't big, let's say 500,000, but none of them wanted to invest. And of course, there was a big question mark for me that what they do know better than I do, and I didn't participate.
Okay.
And maybe to add on that sorry, I need to take your seat. It was enough for me to be so quiet for so long. So maybe to continue on that if you end up having one of the best-known investors on your very early rounds in your company, so if you get the indexes or Atomicos or somebody like that to invest, and if they don't back you up on the next round, that's also very difficult for us to back you in a case like that. So that's a very important part in selecting the early stage investor, that they need to support you, especially if they are known to have money. If they are poor,
Thank you, Riku, for screwing up the whole panel. But he's right that if there are good names whose funds have still a runtime, and they are unwilling to invest, it's a sign of something. And sign is normally that they are not telling you something which you're supposed to know. That if the current investors, current owners of the company have a faith in you, they will participate the round. If they don't, the faith is gone, and then it's some kind of rescue round. And then Sami was talking about these bridges, silta, that there's a bridge that it's like a bridge over troubled waters, you know. Now it's a turbulent times.
Shall we sing?
You wish. The thing is that there's a bridge over troubled waters, but actually in many cases that just new money is required. It's not a bridge, it's a pier, laituri, and then you fall from the pier to water.
In Finland, we have the possibility to do two kind of public equity offerings. It's directed equity offering with the discount, and then it's a rights offering where everybody participates. And the general trend is that in the bad times like this, you switch to rights offerings, so everybody contributes. And it's kind of a requirement that gets a bit unfair in also non-listed companies, that you need to show up the conviction in a wider basis when it's the most difficult time to do that.
And it's interesting that when we went up, the investor said that, hey, I want to do clause which says that I can do in next round double pro rata, when you know it's a safe bet. And now when we're going down, they said, I want to have a liquidation preference. And probably in the legal documents you can see that, hey, let's get rid of these double pro ratas, let's go for the liquidation preference instead.
Yeah, I agree. Clearly the terms have become more investor friendly.
That makes sense. Okay, so let's end up with some tips for the audience. Maybe Kimmo, you can start. But what would you say and a tip for the entrepreneurs to do now when raising a new funding round in the current market?
Keep the faith.
Yeah, it's moving a better direction. One way is to by the way, cultivate one board member or investor to be your kind of a champion in developing your Plan B funding. So you task one guy to be your ambassador on funding.
And Kimmo?
Yeah, well, from the legal terms point of view, I would say that be realistic what is possible. Although I would also say that don't accept everything that the investors are proposing. Normally you can negotiate most of the things, but be realistic what the reality is at the moment.
Great, thank you. Thank you so much for all of you in participating with the panel and with me. Now, I think we still have some questions maybe from the audience, and we have a little bit of time.
There's a couple.
Yeah.
Hi, my name is Alex. I'm CEO of Fidza. Thanks for a great discussion. My question is, so the macroeconomy is very uncertain right now. The interests are really high, but the S&P 500 is still up for the last 2 years. So two questions. In your opinion, what are the reasons why the valuation market has been smashed? And I'm surprised that you're so pessimistic. And second question, is it only in the SaaS market or startup or overall startups?
Yeah, I think SaaS market was overheated and there was so much money floating around. And when there's more demand than supply, the prices tend to go up. And if we take to SP 500, for example, there's 7 companies make 75%, 80% out of the increase that there's your NVIDIAs and other such. And I think Scott Calloway, who was in the Nordic Business Forum, said that NVIDIA is 75% out of those 7 biggest companies growth in an index.
Yeah, the American index is still up, but the rest of the world it tends to be down because they don't have those NVIDIAs or Microsofts to keep it up. The multiples are down, but then in relative terms they are less down in the other sectors than sort of this super scale-up SaaS businesses. But let's say in the general agile ICT services, it used to be 2 times revenues, 13 times EBITDA, and now it's like a 1 times revenues and 8 times EBITDA. So yeah, it's only down 50% down when in SaaS it's 2/3 down, but it's still down.
Yeah, and I'm involved with the big real estate portfolio. Company was valued 1.3 times NAV, net asset value, and now it's valued 0.7 times net asset value. So if somebody would come and buy the portfolio, they would make immediately 30% profit. It is that some markets were overheated, and now it's the flashback of that, and I sincerely hope that soon we are back to the more normal levels, long-term levels in valuations.
Hi, my name is Sailesh. I've been living here for the last 26 years, technically, but I also traveling quite a bit, and I used to work in Nokia and then Hewlett-Packard. So the thing is, now I am actually connected with a huge corpus fund. I'm having a serious challenge how to convince and Finnish companies to get attracted to the big funds. It's a serious challenge I have. Whereas I could close in Brazil pretty easily, but in Finland and the Nordics, it's taking a lot of time. I feel like they're losing the opportunity because I have a really good fund, and we are like stealth of like some of the VIPs and Emirates also part of the fund, like our ultra hedge funds, and also like big funds are there. So somehow my success rate in Finland is not that very encouraging. I feel sad. Thanks.
What's their question?
The question is because maybe because I have like a debt fund and also like equity. Equity is taking too long time. That's discouraging the companies to approach, or what could be the reason? You said like there is a lot of money in US. Yes, I know. There's a lot of money in US, but it's not translating into funding in Europe and extended to Nordic companies. Whereas my success rate is in other countries, like even in Africa and Brazil, we are closing the deals.
Yeah, I guess one way you could try the debt equity combination is this revenue-based funding or venture debt. So if you have a SaaS company, you could get like a sub-1 multiple of debt in there if you kind of fund the customer acquisition cost. That flies in some cases.
Realistically, if you see the term sheet closure, it taking 6 months for equity. For a debt, we have a very good closure. Like in 60 days, we can get the debt even for 10 million. And my limitation is 10 million. I can't go below that one. So that's a serious challenge I have. Maybe I have to figure it out. Some of the advices, what I heard from you, I got a good idea about it. But anyone looking more than 10 million, they can approach me. Thanks.
Yeah, we have this 50 million funding around. Maybe we should talk.
Hey, my name is Tanya Tönroos. I offer CMO as a service. And as you guys know, marketing is pivotal for growth. However, marketing is also the first thing that suffers when times are bad. So I'm wondering if you can share any insights, what you've seen in this year, or like plans for next year from your portfolio companies or companies that you talk to, what the mindset of in marketing is, and like marketing expenditures, if they're pulling back, if they're wanting to invest more because times are bad, anything like that.
Yeah, the customer acquisition cost thinking has getting sharper. So there used to be people burning cash for non-proven growth plans, but now everybody's really sharp focused that your bang for the buck needs to be effective. So you don't just throw your money around, you need to get results from that. So it's getting more scientific.
Yeah, absolutely right. By the way, Meta had an extremely good result, so not everybody's cutting down their marketing. But the thing is that we have in Evli's portfolio company which cut down its marketing, but actually it kept exactly the same level of results. And as Sami said, that it's come more scientific, more calculative. I think quite a few companies when they have less money, they actually use it more smartly. And I'm sorry to say this, but quite a few of your founders, in the past 3 years, you have been bankers instead of entrepreneurs. Entrepreneur is doing something with a smaller budget, being smarter than big corporation and so forth. But then there was so much money floating into the market that some of the founders became just the bankers. Hey, let's burn this money and get the growth, but not using capital in an efficient way. And I think that now, even that companies have reduced some of the marketing cost, they are using it more efficiently, and the results have remained the same or even improved.
Question for all of you guys. So you can only invest in one company, and you are giving all your money away. So what would be the company that you put your money for tomorrow?
Yeah, well, I sometimes do on my podcast this company into sort of analysis. So I had a top fund manager. So I'm gonna go with SpaceX.
Well, I think I'm a cautious lawyer. I would never invest my money just in one company. I cannot imagine any company that I would trust so much that I would put all my money in one company.
That would be absolutely stupidness to put your money into one company. But I would put some index company. That would be my which has some kind of index, EFT, something like that.
Berkshire Hathaway, something.
Yeah, well, those guys are gonna die within 10 years for sure. That's a reality. Somebody would. There are these companies which actually have invested a lot of companies under them. So in that sense, it would be like Shell for the owning a lot of companies.
Norwegian Wealth Fund.
That would be great. Yeah. Okay, there's one company.
No, one fund that does the index well.
I'll put that one, whatever it is.
Thank you, Kimmo. Thank you, Sami. Thank you, Kim. Thank you, Riku. And thank you, Pauliina, for this panel discussion. Thank you all for coming. This was the part of the panel, the part of the program, and now you have the opportunity to stay, network together, or ask questions from our panelists and investors just one-on-one in the space. We will host this breakfast roughly once a month, so we hope we can see you here in the future as well. And for the members of the community, next week we are hosting a community afterworks on Thursday. You can sign up for that on the members portal. And the ones seeking to join the community, just come find Mare01 shirted people, and we are happy to tell more. Thank you all for coming.
You were a great audience.
Thanks.